Hi folks, please read the disclaimer. Today we are going to do an Ask Weekend Investing round. Before that, you can join the 50,000 plus Weekend Investing Community. There's a link in the description. You can fill that small form and you'll start getting premium market insights. So today's Ask Weekend Investing round number 70. We've answered 990 queries so far. See, we've done 69 rounds, so a lot of queries have been answered, and the solutions are there in the description. Do subscribe to our channel if you are a regular viewer and if you wish to be notified for newer contents. First question is from Rakesh. Despite many eye-opening illustrations regarding Lenskart IPO by different learned Fin people, retail portion is fully subscribed on the first day before launch. Don't you think IPO market is in extreme euphoric state? So yes, I agree with you that right now in 2025, IPO market is in a euphoric state and people are buying without really thinking twice, and that usually happens in peak bull markets. But however, in the current situation, the markets cannot be really called in peak bull market situation. We've consolidated for 12 to 14 months already, and we are at the cusp of a new bull market, so as to say. But IPO markets are in a completely different zone, it seems, and people are getting very enamored with bigger names, a popular Gen Z kind of you know uh, popularity with some of the brands that are coming to the market. So question two is, when will people understand that chasing IPO rarely generates generational wealth? Answer is never. Is greed and the urge to gamble always going to overpower common sense? Yes. So what has not changed in the last hundreds of years is not going to change in the next few years also. So the idea will remain that people will, you know, give up their wealth. Uh, Greedy people will give up their wealth to those people who are patient and who have some strategy. That is the wealth transfer mechanism, which I think the stock markets are constantly achieving. Is going from wealth transfer from stupid money to smart money, from impatient people to patient people, from greedy people to you can say people who are not so greedy. So from a momentum perspective, we allow stocks to stabilize after they list. So we never buy stocks immediately after listing. A minimum of 6 to 12 months of uh, cool off period is required, where all the lock in shares, all the initial euphoria has died down. Because if this is going to be a blockbuster uh, IPO, for instance, for the next 10 years, let's say a particular IPO is going to do really well. So then what is the hurry? I mean, we'll make a lot of money on it subsequently also. So there should not be any, rush to try and uh, uh, extract value from a recently listed IPO. Let the IPO and the company prove itself that it is a stable company, it has stable volumes going forward. All that, when it is satisfied, then momentum strategies will start taking a look at it. I hope I answered your question. Let's move to the next one. Deepak says, in the long periods of data that you have analyzed, have you come across any significant time periods where both equity and gold have given negative returns? And if so, what was the extent? So this happens um, every now and then, I would say. Uh, in the longer term, both equity and gold have inverse correlation, but in some short periods, both equity and gold can move in unison. So while both can move upwards many times, sometimes what happens is that when there is a liquidity crisis in the markets, so for instance, the initial part of 2008, the initial part of even COVID, you will find that everything is selling at that time. So if I cannot show you the chart right now, but if you will go back and see those turning points in the market where there was an immediate panic in the market, everything falls during that. But then within a few days or a couple of weeks, you will find that the divergence starts to occur and gold starts to go up even while equity is still falling. So the shock, whenever there is a shock to the system, everything will fall, most likely. Arun says, what is the rationale behind high churn rate in the MI20 strategy? So there is no rationale behind high churn. The uh, MI20 is designed to be a slightly higher churn strategy. And because the small cap and mid caps have been in a lull for 15 months, it seems as if this churn is useless. Actually, the strategy is uh, exactly following what it is supposed to do, where it is trying to avoid deeper losses and staying with the strength of that particular market. Uh, their next part is, while I remain interested in tracking small and mid-cap space, I would prefer a strategy with lower weekly churns. Also, when market has a major drawdown, expect small cash to move to cash, and then they are in the wrong strategy if you are looking to move to cash, because MI20 is a rotational strategy. So you could look at MI25, which is a much lower churn and goes to cash when it goes down. I'm not so sure if going to cash is such a uh, preferable uh, uh, outcome, because see, ultimately you need to spend time in the market to really make money. Going to cash is basically tactical allocation, but reallocating has a lot of lag in that particular strategy, because once a strategy has started to move up, that lag basically also is not so easy to accept. Right now you may be feeling the frustration of that the rotational strategy is not going anywhere. But as the market starts to pick up, whenever it does, you will find immediate traction that happens. In these strategies which will move to cash, that traction may happen after 6 weeks. And that initial 6 weeks are going to be extremely frustrating. So there are, advantages and disadvantages of each style of investing. If you will see any decent period of 5 years, 4 years, 6 years in any strategy, and all of them have the history, you will find that there are times when strategy will not perform, and then there are times when strategy will perform greatly. So these are all non-discretionary. I mean, there's nobody who's deciding that let's have more churn this week or let's not have more churn the next month. It's on an autopilot. So sometimes the strategy wins big, sometimes it doesn't. Rahul Jaiswal says, I'm 26-year-old and exited all mutual funds a month ago. I currently have 2 crores in gold, bought around $3,400 and 1 crore in debt funds, expecting a market crash next year. Do you think this is a good position to hold, or should I diversify further? Rahul, you need a personal finance advisor, which I am certainly not. In general, I can tell you that exiting equity is not a great idea. Expecting market crashes and holding cash for that is also not a great idea. I know people who spent years expecting a crash after 2014, and they got the next one in 2020. So I think in general, one should be allocated and tactically allocated, so that when if and when the market moves in your favor, you are gaining in that front. So perhaps you can be in some sort of a rotational strategy, where once the market does start to pick up, you will get the gains in your portfolio. Regarding your allocation, you will need to talk to financial advisor. Nikhil says, what are the advantages of small cases over mutual funds, considering cost, taxes, or some disadvantages? Can you please explain from a broad perspective? So this is a big sort of a myth that is going around, that small cases have a big disadvantage versus mutual funds. There are many advantages of small cases. Number one is the foremost advantage of having a very clear known strategy style. What is the small case going to achieve, who is driving the small case. In many times mutual funds, people buy mutual funds, they don't even know the name of the mutual fund manager, or if after 6 months of their buying, if the manager changes, the entire thesis could change, right? So this whole concept of black box that a mutual fund is, and because I've dealt as a broking company to mutual funds, I know some of the ills of that industry also. So here it is absolutely crystal clear. Your stocks are in your control. You have amazing crystal clarity in terms of what you want to buy, what you don't want to buy. Uh, you have access to the fund manager. You can understand the strategy. So these are some of the advantages. The disadvantage, which you are saying, costs and taxes. The Let's take an example. Let's say your small case delivers 18% return, right? And let's assume everything is short term capital gains, although on most strategies the blended mix is about 60%. But let's, even for your argument's sake, let's assume everything is short term capital gain, and let's assume 20% is the short term capital gain tax. The plus plus of we'll ignore that for calculation purpose. So at 18% capital gains, 18% returns, let's assume everything is short-term capital gain. So you pay 3.6 out of that as your taxes, right? 20% of 18%. So what is the net inflow to you? It is about 14.4, right? 14.4 is your net post-tax income. Now let's take a mutual fund. Let's assume it delivers you perhaps 15% return. There is some advantage of having a smaller niche of small cases, right? So if a mutual fund delivers you 15%, and let's say you hold it for 1 year and you take long-term capital gain on that, giving the advantage of that. So 12.5% you will pay on that, right? So about 13% will be your net, 13.1% will be your net post-tax income. So you still have a 1.5% advantage when the gross returns were at a gap of 3%. So even if you assume that your small case gave you 18%, while your mutual fund gave you 16%, even then the small case advantage is there. So the gap is extremely small. Please understand that. And in case you have a small case which in the last 5 years has given you a 25% CAGR, you are far ahead of a lot of these. So to come back and summarize the point, there are so many advantages of small case, and yes, there is a tax advantage that is there in mutual funds, but is it worth the reason why you would entirely be in mutual fund? That is something that you have to see. Webber says, for someone who has never invested in gold and wants to start accumulating now from scratch, 25% allocation, what is the strategy considering gold has already run up too hard and perhaps it's maybe the turn of equities in the next year or two post long consolidation? This nobody knows. This is a assumption that you are making, that it has run up too hard. Perhaps the too hard part is yet to come. So I would not, think that a that gold going from $2,000 in 2011 to $4,100, $4,200 now is a hard run over 14 years. It isn't. So if gold goes to let's say $10,000 in the next 3 years, that probably is a good run. So uh, I would not pay too much attention to the gold level. You would want to gradually accumulate. So perhaps have a 2 3 year horizon, that I want to build 5% of allocation this year, I want to go to 10% allocation this next year, then I want to go to 15% allocation. Gradually if you will go, you will not really feel the pain of buying at a short term high, or you're trying to time this. So timing will not work for 99% people and for 99% cases. Timing only works when you are lucky. So, you don't want to commit lump sum money thinking that you may get lucky. I would never do that. So, the idea is that you gradually accumulate, let your equity also run. If you think equities is going to run, let that run, but keep accumulating gradually to gold, and that will gradually build your allocation. Puneet says, how do debt funds and bonds perform in a financial crisis? Don't companies default on their loans? If so, how they are considered to be part of a balanced portfolio? So good question, and let me put a disclaimer here that I am not a bonds person at all. I don't like investing in any fixed income uh, instruments. I think real estate, gold, equities, India and US, this diversification is more than enough for most people, apart from some emergency money that is sitting in your bank or FD or whatever. So, so debt funds for me really don't work. And after the recent taxation change on debt funds, etc., debt funds don't also are not tax friendly instruments anymore. Of course, corporate debt is another animal where if company defaults, your money is gone. So the kind of experience people have had, even with the most pristine bonds, which is the treasury, US Treasury bond. In the last 10 years, investors have made zero money on US Treasury bonds because they were at 5% yield. Then they went to 0.5% yield. So bonds gained. And now 0.5% has become again 4 5%. So those bonds have lost. So over the last 10 years, people have made zero money on those bonds. And 40% of private money sits in those bonds. So you can imagine the kind of opportunity loss that people have had in bonds. I'm not a fan of bonds, so I don't also claim that I have too much knowledge about it. If there are some nuances to debt funds and bonds, I'm not aware of them. Chetan says US Fed is decreasing their repo rates. How will it impact gold price this time? US Fed, whenever it will talk about any dovishness or reducing rates, gold will go up. Last time when the US Fed reduced the rates to as low as zero during COVID, gold price got doubled. So I don't know whether it can go to zero or not, but gold is certainly a direct correlation to rates going down. Is gold ETF the next best option for investing in non-physical gold as RBI stopped issuing SGB now? So post the stoppage of issuance of SGB, certainly the non-physical gold options are limited, primarily to gold ETF, gold mutual funds, uh, digital gold, which of course is not regulated. So gold ETFs are a good option. SGBs, if you can find them at below value, SGBs still have a, I think the last SGBs that are going to mature are in 2032. So you still have a good 6 7 year run in several of those listed SGBs. So at any time, if you find that they are underpriced, you could buy those as well. So ETFs and listed SGBs are probably good. Srihari says, I have been following you for a year now and I've recently joined X and I'm seeing a lot of data, a lot of research readily available for equity and real estate in US. How can we get similar data for India? So there are handles who frequently disseminate real estate data for India. And although that um, depth of that data and the breadth of that data is quite limited, that data is just not uh, collated anywhere. There's no central agency which is doing that. Equity, lot of data is available. I think if you go to any equity portal, all kinds of data are available. I'm not sure what data you're not able to find, but there are professional agencies also that are ready to give you equity research. So I think data is available of equity. Real estate in India is still a bit of a, I would say, a black box in terms of a lot of data being available. Syed Ali says, do you believe Indian markets can give the same returns for the next 30 years as it has given before? Well, I would love to believe that, but I am not going to put my bets on it. See, there is a difference that I'm optimistic on India. Will I say that, I'm not going to invest in any other asset class because I'm optimistic on Indian equity? No, I'm not going to do that. So I will invest across different asset classes. I will allow the India growth story to continue, whether or not India equity participates in that like 30 years or not. Even in the last 50 years, if you see, from 1980s till mid 90s, the growth that Indian market saw in those years has never been replicated. The growth that we got in 2003 to 2008 did not get replicated even in COVID years. So each decade has its own trajectory. As Indian market become more and more mature, the sort of returns that you will get out of the markets may also start to temper down. So to answer your question, um, will we have the next 30 years like we had so far? I think it may be difficult. It all depends upon where and how India growth story goes from here. Because right now we have a very stable government. We have reasonably good uh, governance. What happens in 10 years? What happens in 15 years? Nobody knows what kind of leadership we get, what kind of ruling parties we get, what policies are getting made. Nobody can say. I mean, forget 30 years, nobody can say what happens in 10 years. So, from that perspective, keep your assets allocated to different asset classes and hope for the best. Oh, this is a chart that my team has put in. So if we were to go in the same sort of trajectory, we will go to very lofty targets. But as we have seen with China, as we have seen with uh, matured countries, the linearity will not remain in the next same time. So all previous episodes are here in the description below. All the videos are there. There are 69 videos, I believe, and you can watch them and look at and get your questions answered. If I've missed some questions today, you can always send me your emailed question, and we will answer it back. Thank you so much for watching. If you liked our content, do subscribe to our channel and do give us a like. Thanks. Bye.